Can I save money in an S corporation? What are the advantages? What are the disadvantages of an S corporation? This video is going to go through my top 3 pros and cons of S corporations, and also stay tuned to the end of the video. I've got one more tax consideration if you're currently an S corporation or you're contemplating on becoming an S corporation. So you want to listen to that and check that out. So let's go. Pro number 1, if you're an owner, shareholder within an S corporation, you can save payroll taxes by paying yourself with distributions instead of W-2 wages. If you are not that familiar with payroll taxes, I'm talking Social Security, Medicare taxes, I've got 2 videos that I suggest watching, maybe even before you continue the rest of this video, so you can get a better idea of what payroll taxes are. Okay, we're gonna cover 2 scenarios, shareholder A, shareholder B. Shareholder A is gonna pay themselves $10,000 in W-2 wages. Shareholder B is gonna pay themselves $10,000 in distributions. Let's look what happens with the tax rates on each situation. Shareholder A pays themselves $10,000 in W-2 wages. Let's assume they have a 37% income tax rate, and then they're also gonna have to pay payroll taxes, Social Security of 6.2, Medicare of 1.45%. That gives a total tax rate for that shareholder of 44.65%. In addition, the S corporation is going to have to throw in another 7.65% to match the payroll taxes, the Medicare and the Social Security, the 6.2 and the 1.45 for a total of 7.65. Now let's look at shareholder B. Shareholder B pays themselves $10,000 in a distribution. Now, let's assume the income tax rate is the same as 37%. However, with a distribution, there's no payroll taxes, there's no Social Security, there's no Medicare, and in addition, the S corporation doesn't have to match the payroll taxes as well. The shareholder is saving 7.65% in payroll taxes, and the corporation, the S corporation, is saving 7.65% in payroll taxes as well. So let's break the math down. Shareholder A on that $10,000 has $4,465 in taxes. The S corporation also has $765 in taxes to pay, for a total of $5,230 of taxes for that $10,000 of W-2 wages. Now let's look at shareholder B, who paid themselves a distribution of $10,000. We're assuming the 37% tax rate. They have a $3,700 income tax bill, no payroll taxes. The business doesn't have payroll taxes either, so the total tax bill is $3,700. So you're looking at a $1,500 delta between shareholder A and shareholder B's tax bill in relation to paying themselves $10,000. So with an S corporation, you get the benefits of both worlds. You get the benefits of being a corporation, where you can perpetuate the existence of the entity. You get the limited liability protection. You also get the ability to issue stock to your shareholders. And it's a depending on the circumstances, it's not all circumstances, but when you go to sell shares from different shareholders, it's a lot easier within a corporation to transfer ownership compared to an LLC or a limited partnership, and definitely a sole proprietor. Alright, tax warning. I'm going to use the kitchen table talk here instead of the technical terms. I'm going to try at least. So, third point, Section 199A, I'm already off to a bad start, QBI deduction. Basically, if you're an S corporation or any sort of pass-through entity, you get a 20% deduction for your income. What I mean by that is basically your qualified business income is only 80% taxed. Even though 100% is going to come through on your 1040, 20% of that is going to be a QBI deduction. So if you have $100,000 of QBI, you get a 20% QBI deduction. Take your $100,000 of QBI, $20,000 deduction, you have $80,000 of taxable income from your S corporation business in that situation. That is huge tax savings compared to an C-Corp. QBI does have a bunch of exceptions. It can get really technical, but just to keep it as the highest level possible, there's language within that tax law that will not allow certain services to get this QBI deduction. So as long as you don't fall in that bucket, you're going to get this 20% QBI deduction. If you've already gotten some value out of this video, please go ahead and smash that like button. And we're going to continue with the cons. All right, con number one, and at surface level, this doesn't seem like a big deal, but it can be extremely frustrating. If you have multiple shareholders and you're trying to develop compensation plans for all the shareholders, a lot of times a larger shareholder and a smaller shareholder, their compensation models just will not fit nicely to achieve the pro number one of avoiding the payroll tax. For example, you have we'll go back to shareholder A. Shareholder A has a $200,000 compensation model, but they're only a 10% owner. So at the end of the day, let's say there's $1 million to distribute. They're due $200,000. Since you have to distribute that $1 million pro rata, since they're only a 10% owner, they're only going to get a $100,000 distribution, and then you got a bonus, the additional $100,000, which in that situation, you're not getting the payroll tax benefits that we talked about in pro number one. All right, con number two, and this is a big limitation if you're trying to scale a large business with multiple shareholders. As corporations, you're limited to 100 shareholders and one class of stock. So if you want preferred stock, not an S corporation. If you want 101 shareholders, can't do an S corporation. That's where an S corporation can get a little challenging when you're trying to scale from a small business to a big business, because if you keep adding more shareholders, eventually you're going to hit a level where you go over 100, you lose your S status in that situation. Also, if you want to issue preferred shares or common class A, class B, can't do it within an S corporation. One share class, that's it. Owners of an S corporation, those shareholders, it's got to be an individual. There are some exceptions for some types of trusts, but it's got to be a person. It's got to be Patrick Bray owning those shares. Can't be Patrick Bray LLC owning those shares. So an LLC, a C corporation, a partnership can't own shares of an S corporation. Now, technically, an S corporation can own 100% of another S corporation shares. That's just viewed as a disregarded entity. That can pose challenges when you're trying to raise money. If you have a partnership that wants to invest, an LLC that wants to invest, can't do it. Got to keep it to the individual level, and that is a big restriction for S corporations. If you know somebody that can benefit from this information, please share this with them. Go ahead and forward it to them so they can watch this video as well. All right, the last thing I wanted to add on to this video, I'm not going to go into great detail. I'm going to do a full video on this, but state and local tax deductions. You can save a ton of tax money if you have your S corporation pay for the shareholder state taxes from the S corp level. The S corporation is going to get a federal deduction for those state taxes instead of the individual paying them at the 1040, their individual level. That is a huge tax savings. Now, it doesn't apply to every state. Each state's got to ratify that and be okay with it. Now that you know a lot more about S corporations, let's go check those payroll tax videos out if you haven't already. That's going to help a lot with the pros and cons in this situation if you fully understand Social Security and Medicare taxes. All right, everyone. Have a good rest of your day. Take care.